Warm welcome to everybody. There is a adage that says, "May we all live in interesting times." While we do definitely lead interesting lives currently, especially since what is happening all over. But Indian financial markets also are witnessing interesting times. The market consensus was that on the recently concluded policy, RBI would be cutting rates. However, they surprised the market with just change in the stance. They changed the stance, which many a times is a precursor to actual rate action. The stance has been changed from withdrawal of accommodation to accommodation neutral, which is a more dovish, which is a much more dovish situation. While the repo rate has been unchanged and kept at 6.5, this is predominantly due to little bit of uncertainty on the inflation, while the growth is still holding up. Monetary policies generally are viewed from a very simplistic prism of growth inflation dynamics. If we all recall, RBI mandate is such that they are in charge of keeping the inflation into a broad range of 2% to 6%. 4% is the key, and plus minus 2% on both the sides. So for them, the broad range is, the band is 2% to 6%, while inflation till now has been very much into that, in fact near to 4%. And the inflation outlook is also such that it is likely to be near to 4%. However, there has been a couple of spikes, which is causing the thought that inflation is not 100% under the control. In a developing country like India, inflation and the price rises are quick to come on the fore, and very slow when they start reducing. So that is the one part of the equation, that is the one portion where very hawk eye vision is needed to control the inflation and prevent it from spiraling out of the control. If we were to get little bit into the details of the inflation, food inflation is playing a major villain over here. Food inflation continues to be on the higher side. In fact, it is higher than the average basket. So if I were to pick a number, which is that, what is the food inflation? Food inflation is coming to more than 9% at this point in time, and that is taking the entire inflation basket upwards. So if the previous inflation number was sub 5, food inflation was nearly 9.2, and hence the entire basket got pulled up to 5.5. Having said that, food inflation is one part. The second part is the base effect that comes into the play. Previous year number for the same period was substantially lower, and any inflation higher than that, obviously because of a lower base effect, will come to a spike. We estimate at Ambit estimate that our next number, the October number, will also be on the higher side, obviously due to the base effect, and then it might start dipping. At the same time, the monsoon has been good, and there is not seeming to be any massive shortages reported into any of the food, especially the onions, potatoes, and and the lentils. And with a good kharif harvest and ample buffer stock, uh, don't expect food inflation to spike substantially from here. As long as it remains soft, the inflation CPI will start dipping, and we will see the numbers that are projected, that is likely to be between 4 to 4.5 from here on for the rest of the year. So this comes well within the entire basket of inflation being softer and being under control, and that actually opens up the road ahead for RBI to focus on growth, and hence the need to shift the policy from hawkish to now to neutral, and then eventually accommodative. And as I said, it has been preceded by change in the stance. Coming to growth, growth has been healthy. Growth has been healthy, even though it is not stupendous, but it has been healthy. I mean, globally, if we see all over, India is the only country to witness growth, 6% growth on a continuous basis. All the agencies have been mentioning that India will be having growth of 6%, 6.5% plus. In fact, RBI in the latest guidance is suggesting that we will have growth of 7.2% for the entire year. And I think that signs that showcases well for the economy as a whole, because while inflation control is one part, you don't want growth to be suffocated so much that we actually enter into recession. A developing country like India ideally needs reasonable inflation and a higher growth, which RBI, and I mean RBI with the monetary policies and the government with the fiscal policies has been managing well. Even the high frequency economic indicators like GST collections, the e-way bills, the purchase manager indexes collections, the GVAs, all have been showcasing that we are having healthy growth. It's just that before any little bit of slowdown starts manifesting and becoming permanent, it needs a boost. It needs a monetary boost, fiscal boost coming from the government and its policies. It needs a monetary boost from RBI, and there is no monetary boost other than softer interest rates, which occurs as a case of eventually cut. So the one part of the equation is your inflation is getting under control, and the other part is your growth, even though healthy, it needs little bit of support. So it's question of RBI cutting the rates is not the question. The question is just when. And as investors, as evolved investors, we should not be worried too much about the timing of the actual rate cut. When the direction itself is very broadly clear. From a macro perspective, even we are very strongly placed in terms of the forex currency size that we are having. More than $700 billion is the current foreign exchange reserves that we continue to hold. Two parts to the coin. Extremely high forex reserves make the sovereign balance sheet, India's balance sheet as a whole, substantially stronger, because you are predominantly importing country, and hence higher the forex reserves, higher, more stable you are economically, because higher is your capacity to withstand any shock. The second order thinking is higher the forex reserves, it means you have more dollar inflows coming into the country, which again shall indicate that there is a higher level of interest that is building up over a period of time into the financial markets. So massive amount of actually $700 billion is the highest ever reserves that we ever had, and that showcases extremely healthy forex reserves and the stability it creates to the entire India's economic scenario as a whole from a very global perspective. Coupled, I mean, this inflation and the growth again is at the core of the entire monetary policy, which currently showcases that we are in a softer phase of the interest rates journey as a whole. If we were to take the journey of the 10-year benchmark GSEC bond, which is taken as a mirror from April 24 onwards, it would be approximately 7.1%, and the moment at this point in time when we are speaking, it has come down to 6.77. What does that showcase? That simply showcases that market and the powers to be have been reading the economic situation very correctly, and obviously markets are always ahead of the curve, and it is witnessing that now things are very much into the control of the policies of the policy makers, predominantly being inflation, and rate cuts are expected sooner rather than later. Advantage of rate cuts, obviously, we all know advantage of rate cuts is it increases the price and the capital appreciation that comes with long duration bonds. However, there is one more change that is happening right in front of our eyes. Indian fixed income markets are going into a structural change. If we were to say, this is predominantly because foreign participants are increasing on its own, and secondly, Indian bonds have been included into three global bond indices, latest being Russell FTSE. Before that it was JP Morgan, and before that it was Bloomberg. These three global bond indices enable the passive investor of these indices to start investing into Indian bonds, and they come as flows. And if we were to look at pure economics, pure commerce, which we would have studied and understood, it is demand supply. Another set of big buyer is emerging, and the supply of bonds from government of India, which is the borrower technically. 10-year benchmark bond, technically over here, government of India is a borrower for 10 years and is a supplier of that bond, and we all are technically purchasers slash we all are in demand of that bond. So there is another massive set of demand that is going to come from foreign investors, predominantly because of this. So now you have a rate cut scenario where your interest rates are likely to fall over a period of time, and at the same time you also have another set of buyers emerging that is going to increase the demand. So two levers to the entire fixed income story at this point in time, why it makes eminent sense. Obviously the rate cut cycle, and as I said, the increasing set of buyers emerging, and that is making the demand supply equation extremely favorable for the investors who are investing bit early before the market is taking into the actual rate cut as and when they happen. In fact, if you look at the monthly FPI curves, September has seen massive numbers in terms of debt investors on an overall basis. Coming to the portfolio that we run, the strategy that we run, we predominantly run a dynamic strategy. It is dynamic in sense that it invests across the curve in terms of the duration dynamically. So last year, when the outlook was not so positive, the dynamic way of managing duration would have been to investing into extremely short-term papers to avoid any MTM losses. But at this point in time, when the outlook ahead is such that we are expecting fall in the yields, the duration dynamically goes higher, and we invest into long duration bonds. The framework is built in such a way that the focus is predominantly on safety, then liquidity, and then returns. Fixed income per se is more for preservation of capital and preservation of your wealth, where risk shouldn't be added to the portfolio. And over here, the same perspectives are kept into mind, and the framework has been built. So for that purpose, the portfolio is built in such a way that at least 50% of the portfolio, irrespective of the duration or the maturity profile of the underlying instruments, is invested into GSECs or state development loans or AAA, high quality AAA bonds like maybe an HDFC or LIC or Reliance Industries or L&T Limited or maybe Tata Group. So at least 50% of the portfolio is AAA. That ensures extremely high safety, ensures extremely high liquidity, without sacrificing of returns. And the other 50% of the portfolio is filled with securities which are in the handle of A to A minus, with individual caps of A minus being not more than 30, A being not more than 40, and A plus not being more than 50%. in that A to A minus category, predominantly the duration is always short duration. Over there, the visibility is such that we want to be invested into a company only for 1.5 to 2 years while enjoying higher returns and higher yields predominantly, and we don't want to add the duration risk or the private balance sheet going bad from here on, or maybe a sectoral mismatches aligning. So if you were to look at it, the portfolio is built in such a way that it is like a barbell. On the one end of the barbell is AAA portfolio, which enables capital gains as and when the interest rate scenario, which is likely to be turning positive, with a medium accrual generated. And the other end of the barbell portfolio is such that there are high yield papers which are extremely well researched, extremely well covenanted, and very tightly controlled in terms of understanding the flows, which generate a constant accrual of 9.5 to 10%, and the weighted average of the entire barbell giving optimum scientific mix between capital appreciation possibilities on the one end, when the yield curve shifts downwards, and on the other end you would have constant accrual coming at 9.5 to 10%. Dynamic debt hedge portfolio, they're managed dynamically, and it over here the focus is such that it is built in such a way that it is technically a all seasons strategy, and depending upon what is the season of, whether the season is of capital gains because of higher duration, then we toggle to a higher duration AAA papers, and when as and when the situation is such the duration is no longer extremely positive, the toggling is towards the shorter duration but higher accrual in terms of 10% and 11% investments. And that is how the entire endeavor is to protect principal, the safety of the principal, keep the entire portfolio liquid, and generate returns. Ideal investments horizon ideally is at least 18 to 24 months. This enables you as investor and me as fund manager to lock in rates before the rates actually start cutting. I mean, the interest rates being cut and the rates start coming down. Lock in high yield rates at this point in time without having the reinvestment risk. Reinvestment risk being one of the bigger risk which many people uh, are not able to price it, and hence they suffer. The ability to lock in higher yields is extremely crucial to building a very optimal fixed income portfolio. And on the other end, you also have to be situationally present into the part of the curve where capital gains will be coming over a period of time, and to enable capital gains that come with unable to enjoy capital gains tax on the capital gains that will accrue. Uh, we have long-term capital gains at 12.5% if we hold the instrument for more than 12 months, and hence ideal investment horizon scenario is 18 to 24 months, where the rate cut cycle is likely to be there. On the portfolios we would be earning capital gain, and we should be making it much more tax efficient by paying long-term capital gains tax rather than the short-term capital gains tax, which is at 20%. Ideally, by staying invested for more than 13, 14, 15 months, you are saving nearly 8% of your taxes, which adds to the alpha, and which predominantly increases the delta generated over next 4 to 5 months, 5 months of additional investments being there. As I said, the weighted average portfolio currently is 10% plus, comprising of AAA, AA, and A handle papers. Portfolio returns since inception on an annualized basis is 12%, more than 12% post expenses, and the weighted average duration is 3.25 years. Predominantly of Government of India securities, GSECs as we call them, and other A handle papers with 18 to 24 months maturity. Yeah, the investment horizon of 18 to 24 months is the most optimal, as that as we suggest to get the best of both the worlds.